All right, let's dive right into this explainer. Today, we're putting biotech giant Incyte through what I like to call the ultimate valuation gauntlet. As an investment analyst, biopharma is always a really unique puzzle. You're constantly weighing these massive immediate cash flows against the ticking time bomb of patent expirations. So we're looking at Incyte Corporation today, ticker INCY. And we're not just glancing at their latest earnings report. We are going to seriously stress test this stock using the exact frameworks of legendary investors Warren Buffett, Peter Lynch, and Benjamin Graham, right before we run our own hard quantitative models. Here's our roadmap for today. We'll start with a quick company snapshot, view the stock through the lenses of Buffett, Lynch, and Graham, crunch the DCF and comparable models, and then wrap it all up with our final verdict. Okay, section 1. Incyte, the company's snapshot. Let's get our bearings. So what exactly are we dealing with here? Founded back in 1991, Incyte has totally transformed from a genomics research firm into this commercial stage powerhouse focused on cancer and inflammatory diseases. They're trading at roughly $127 a share with a market cap around $24 billion, and man, the financial momentum is incredible. In Q2 of 2026, they posted a staggering 37.7% year-over-year revenue growth. They hit $1.67 billion for just that quarter. And not only did they absolutely crush analyst estimates, but they're doing it while sitting on a jaw-dropping $4.5 billion war chest of cash and marketable securities. Plus, their adjusted operating margin jumped to 44%, which is just a masterclass in efficiency. But, and this is a massive but, here is the central tension of our whole analysis today. It's the elephant in the room. Incyte has this explosive pipeline growth right now. I mean, their non-steroidal eczema cream, Opzelura, saw sales jump 33% in 2025 to $678 million, and they have 10 phase 3 clinical studies happening right now. But all of this incredible growth is on a direct collision course with a looming 2028 patent cliff for their main moneymaker, Jakafi. That one blood cancer drug makes up roughly 60% of their revenue. So, knowing all that, the big question is, would the Oracle of Omaha, Warren Buffett, want a piece of this action? We know Buffett loves businesses he can fundamentally understand, with super durable competitive advantages and shareholder-friendly management. If we run Incyte through Buffett's qualitative checklist, they actually pass with flying colors. Strong pharmaceutical patents? Check. That's a solid economic moat. Consistent earnings? Check. They've got a 5-year annualized revenue growth of 16.7%. High ROE? Absolutely. And debt? It's literally a non-issue with that $4.5 billion cash pile. Management has also stayed super focused. But the ultimate test for Buffett is how durable that moat really is. That 2028 patent drop-off for Jakafi throws a huge wrench into the long-term consistency he craves. To really do Buffett's math, we need to calculate his favorite metric, owner earnings. Now, since our source data doesn't give us the exact cash flow statement, we're going to make a logical assumption and use the trailing 12-month net income of $1.61 billion as our proxy for free cash flow. Running those numbers tells us the stock is pretty much fairly valued right now at $127. But here's the catch. Buffett demands a strict margin of safety, usually a 20% discount below intrinsic value. So at today's price, Incyte just doesn't have that buffer. He'd probably be sitting on his hands, waiting for a market pullback.
All right, let's shift gears and look through Peter Lynch's lens. The legendary Magellan fund manager loves categorizing companies to really nail down their story, and he is famous for hunting for growth at a reasonable price.
Lynch would almost certainly categorize Incyte as a fast grower that's slowly morphing into a stalwart. That recent 37.7% quarterly revenue spike screams fast grower, but their sheer size hints at a stalwart, and he would absolutely drool over their balance sheet. Having $4.5 billion in cash gives them so much firepower to acquire new assets, like they just did with Latarcibart for hematology, to replace whatever revenue they lose from Jakafi. Which brings us to Lynch's holy grail, the PEG ratio. That's the price-to-earnings ratio divided by the growth rate. Let's do the math. Incyte posted an adjusted Q2 EPS of $3.09. With a PE ratio of 14.45 and a 5-year annualized growth rate of 16.7%, we get a PEG ratio of 0.86. For Lynch, anything below 1.0 is undervalued. This metric firmly plants Incyte in Peter Lynch's buy territory. He'd love the massive growth you're getting for the price you're paying today. But hold on, what about the father of value investing, Benjamin Graham? Will he be as forgiving? Graham is the ultimate defensive investor. He doesn't care about the exciting pipeline narrative. He only cares about cold, hard asset protection and yield. Graham's defensive checklist is notoriously brutal. Now, Incyte easily passes his test for a moderate PE at 14.45. They have great earning stability and obviously an exceptional financial condition with all that cash. But step 4? Incyte hits a literal brick wall. The company pays 0 dividends. For a purely defensive Graham investor, lacking a dividend record is an instant deal breaker. It's a complete fail on this step.
And if we force it and run his famous intrinsic value formula anyway, the square root of 22.5 times earnings per share times book value per share, the result is pretty sobering. Using a normalized EPS of $8.96 and an estimated book value around $35, the formula spits out an intrinsic value of roughly $84. So at $127 today, Graham wouldn't even look at the stock without a massive price crash. It's just too rich for his blood.
Okay, moving to Section 5, let's step out of the history books and run some modern DCF and comparable models. Building a base case discounted cash flow model means making some very specific assumptions. First, we're sticking with net income as our free cash flow proxy. Second, we are modeling a really robust 15% growth rate all the way to 2028 because, let's face it, Opzelura and their oncology pipeline are firing on all cylinders. But third, we have to respect the patent cliff, so we're forcefully dropping our terminal growth rate down to a super conservative 2% after 2028. Finally, we discount all those future cash flows back to today using an 8% weighted average cost of capital.
The sensitivity analysis here gives us some really fascinating results. Even when we bake that severe 2028 patent cliff into our 8% discount rate and just 2% terminal growth, our base case still yields a fair value of $150 per share. And hey, if they manage just a slightly better terminal growth of 3%, say those phase 3 trials pay off, the fair value jumps to $165. The math here tells us there's still significant upside left on the table.
Let's gut check that DCF with a quick comparables model. When you stack Incyte's PE of 14.45 up against its peers, it's a night and day difference. Amgen is sitting at an estimated PE around 21.5, and Eli Lilly is trading at an astronomical multiple over 100. Even when you adjust for the differences in scale and specific drug pipelines, Incyte looks severely undervalued compared to the rest of the biopharma sector right now. Which brings us to Section 6, the synthesis, and our final verdict.
We have officially run the gauntlet. We channeled the greatest investing minds in history and ran the modern quants. Here is how it all shakes out. The modern models, our DCF and comparables, along with Peter Lynch, absolutely love the growth, the cash, and the cheap valuation. They're screaming, buy. Ben Graham, on the other hand, gives it a hard sell because of the missing dividend and high price to book. And Warren Buffett? He's sitting right on the fence as a hold, waiting for a wider margin of safety, closer to $120. Ultimately, this whole investment boils down to one massive fulcrum. Do you believe their phenomenal execution today, that $4.5 billion war chest, and those 10 late-stage pipeline drugs can outrun the revenue vacuum coming in 2028? The data proves they definitely have the capital to pull it off. So based strictly on the data and heavily weighing their massive cash generation against those low current multiples, our final verdict as an investment analyst is a cautious buy at the current price of $127.75. A 16% growth rate at a 14 PE is just too strong to ignore. That said, if you're a deep value purist, you might want to set your limit orders at $100 for Buffett, or way down at $56 if you want Graham's extreme safety. So I'll leave you with this to chew on. When you're staring down a complex, cash-rich biotech stock facing a massive patent cliff, which legendary guru's philosophy do you actually trust with your own hard-earned money? Are you betting on Lunch's growth or Graham's defense? Think about it. Thanks for joining me on this explainer, and keep questioning the data.